After the last crisis, the world searched for safety. Not safety in theory, safety in structure. Governments, regulators, and central banks all asked the same question: how do we make sure this never happens again? The answer they settled on sounded reasonable. If banks were the problem, then banks needed to be controlled. Capital requirements were raised, risk models were rewritten, stress tests were introduced. On paper, the financial system became safer than it had ever been. But safety in one place often creates danger somewhere else. And the moment the traditional banking system was tightened, something else began to grow. Quietly, legally, and almost completely unnoticed. It was called the shadow banking system. Not because it was illegal, not because it was secret, but because it lived outside the spotlight. Shadow banking wasn't a single institution or a single market. It was a web. Money market funds, hedge funds, private credit firms, structured investment vehicles, repo markets, special purpose entities. Individually, none of them looked dangerous. Together, they became enormous. Trillions of dollars flowed into these structures because they offered what investors wanted most after the crisis: returns without responsibility, liquidity without regulation, risk without visibility. And once again, the system rewarded those who moved fastest. In the years following the crisis, interest rates remained near zero. Traditional savings became pointless. Safe assets stopped producing income. So investors went hunting. Pension funds needed yield. Insurance companies needed returns. Endowments needed performance. And shadow banking was ready. Private credit stepped in where banks pulled back. Leveraged loans replaced traditional lending. Complex debt instruments promised steady income with minimal risk. The story sounded familiar. This time is different. These are safer structures. The models are better. But beneath the surface, the same incentives were back. Borrow more, leverage more, stretch assumptions. Because when money is cheap, leverage feels harmless. And when leverage feels harmless, it spreads. One of the most critical pieces of this hidden system was something most people had never heard of: the repo market. Short for repurchase agreements, the repo market is where institutions borrow and lend cash overnight, using securities as collateral. It's the plumbing of modern finance: invisible, essential, fragile. In theory, repos are safe. In practice, they rely entirely on trust. Trust that collateral can be sold. Trust that prices will hold. Trust that liquidity will always exist. In 2008, when that trust broke, the system froze. Afterward, reforms were promised, but the market grew anyway. By the late 2010s, the repo market had quietly ballooned into the tens of trillions, and almost no one outside the industry was paying attention. At the same time, financial markets became faster than human comprehension. Algorithms replaced traders. Automated strategies replaced discretion. Decisions were executed in milliseconds. Speed created efficiency, but it also created fragility. When machines react to the same signals at the same time, Markets no longer move smoothly. They jump. Liquidity vanishes not gradually, but instantly. And when something goes wrong, there is no pause button, only feedback loops. This new system didn't fear downturns. It assumed they would be managed, because central banks had proven something powerful. They would intervene. Every crisis since 2008 had been met with stimulus. Every panic had been softened. Every shock had been absorbed. Markets learned the lesson. Risk was no longer priced honestly. It was priced politically. Investors began to believe that losses were temporary, but gains were permanent. That belief changed behavior. More leverage, more complexity, more confidence. And slowly, the system became dependent on rescue. Not just financially, psychologically. When stress appeared, markets didn't ask if help would come. They asked how fast. But intervention has a cost. Every rescue sets a precedent. Every bailout reshapes expectations. And eventually, the system forgets how to stand on its own. Warning signs began appearing. Liquidity mismatches in supposedly safe funds. Private credit markets showing cracks. Banks struggling with assets they couldn't easily sell. Then came moments that should have triggered alarms. In 2019, the repo market suddenly seized up. Interest rates spiked overnight. Liquidity evaporated. The response was immediate. The Federal Reserve stepped in. Massive injections of cash stabilized the system. The public barely noticed, but insiders did. Because the problem wasn't a lack of money, it was a lack of trust. And trust, once damaged, doesn't repair itself. It only gets replaced by guarantees. Then came the pandemic. An event so extreme it justified extraordinary measures. Markets collapsed and were rescued faster than ever before. Trillions more were created. Balance sheets exploded. Risk assets soared. Once again, collapse was postponed. But the system grew even more dependent. By now, the financial world was no longer built on fundamentals alone. It was built on expectations of support. Support from central banks, support from governments, support from institutions considered too important to fail. And that's where danger lives, because systems that rely on intervention don't fail slowly. They fail suddenly, all at once. When confidence breaks, leverage unwinds faster than it was built. Assets that looked liquid become impossible to sell. Collateral loses value. Margin calls cascade. And the shadow system, invisible in good times, becomes impossible to ignore. The greatest risk today isn't that we'll repeat the last crisis exactly. It's that the next one will come from somewhere that looks boring. A corner of the market few understand. A structure most people assume is safe. A product designed to reduce risk, not amplify it. History doesn't repeat itself, but it rhymes. And the rhyme is familiar. Complexity, complacency, confidence. The system didn't become safer after the crisis. It became harder to see. And when danger hides well enough, it grows unchecked. The question is no longer whether another shock will come. The question is whether the system can survive without intervention when it does. Because each rescue leaves less room for the next one. And when that limit is reached, there are no easy solutions. only consequences. What happens next depends on whether anyone is willing to see the risk clearly before it demands attention. Because the shadow system isn't waiting to be discovered. It's already here. And what it enables next will define the future of global finance. Welcome to Cash and Chronicles, where money, power, and history collide.